Very like.
When your money goes really far. Something to consider. I
Before I ask my usual question, just a plea that if you can remember to bring your nameplates, it helps me a great deal because I can call on you more easily. I know you have a lot on your mind, so if you forget, it's not a big deal, but if you can remember, that'll be great. So let me jump to the question that I promised you I would ask at the start of every class, at least through the first couple of weeks. How many of you have not picked a company to value yet? Notice the framing of the question has changed. How many of you have not picked a company? You do realize that I can look at the master list and see how many I have not picked, right? So this is like a rhetorical question. There are still quite a few of you who haven't picked a company or you haven't entered the master list. Either way, please fix it. No. Because as you will see, if you have a company, an actual company to work with, things become more tangible, right? Risk-free rates, risk premiums, betas, cost of capital, cash flows. It's easier if you actually have a real company to work with rather than abstractions. I also want to ask a question about groups. I know there are a few people who are still struggling to find groups. Is there anybody in this class who's not in a group yet? Okay. I would like the other groups to see if they have room for an extra person, because I'm going to put up Joe up for adoption here. And he's a very good person to have in your group. He's promised me to pick the young, high growth, money losing company for you. Yeah. But please, so that's the only nudging I can do. So hopefully somebody will approach you after this class. So let's talk about risk-free rates. But today, actually, at the start of the class, I'm going to talk about the thing that we're going to move to after risk-free rates, which is equity risk premiums. Let me frame what we're trying to estimate. The risk-free rate is what you're guaranteed to make, right? And we talked about how to get it for a currency where it's easy, maybe the Swiss franc, maybe the US dollar, and even where it's difficult, the Indian rupee, the Brazilian real. Let's say the risk-free rate, stay in dollars. Right now, the T-bond rate at the start of today was about 4.5%. So you can put your money into a T-bond for the next 10 years, and you're guaranteed to earn 4.5%, with the caveat being that the US Treasury might default, but let's keep that out of the picture, 4.5%. You know what the equity risk premium is? It's what you would demand over and above that 4.5% to invest in equities as a class. Let's start with the easy part of that question. If you can make 4.5% guaranteed, would you demand a higher return or a lower return for investing in equities as a class? As an expected return, you demand more, right? The actual returns might be lower. That's a risk. But it would be crazy to say, I'll take 3.5% on stocks if you can make 4.5% guaranteed. The equity risk premium is that extra number you would charge. And already you can see why this is going to be so difficult to estimate. Will it be different across the people in this room? And what drives those differences? Risk aversion. If you're more risk averse, you'll charge a higher premium. Doesn't make it right or wrong. It's just differences. And we're trying to estimate one number for the entire market. Think of the millions of people in this market. You can't go around and ask how risk averse are you, how risk averse are you, and then try to figure it out. So we struggled with how best to estimate the number. 95% of valuations, here's how that number gets estimated. People look backwards. What does that mean? To estimate what you can make over and above the risk-free rate, you look at 100 years of stock market history in the US, and you look at what stocks have earned over and above something that you call riskless treasuries, for instance. Let's say that's 3%. Say that's what I earned in the last 100 years. That's what I can expect to make in the future. First, when you do this, what are you assuming about the future? It's going to look like the past. It's called mean reversion, but you assume that the past will look like the. Is that a good assumption? No, don't be so quick to say no, because we do this all the time in valuation, right? We use margins. So if you say no here, I'm going to come back and haunt you for the rest of this class, because we assume mean reversion in some things and we don't assume mean reversion in others. So let me reframe the question. Under what conditions is it okay to assume mean reversion? Julian. Long is one condition, so that's a statistical requirement, but it's more than just long, right? For the future to look like the past, the system has to be pretty stable. There can't be a structural break. I'll give you an example. Say you sign Justin Verlander, San Francisco Giants. It's legendary pitcher, has won 5 Cy Youngs. His lifetime ERA is like 2 point something, which is, if you have not tracked baseball, is a really good ERA. And the Giants signed. Historically, he's won like 16 to 20 games a season. So I'm going to use mean reversion, assume that he's going to win 20 games next season. Jacob, what's the problem with my assumption? You follow baseball, it would be unfair to ask you if not.
I don't follow that.
Okay. Anybody who's a baseball fan, tell me what's.
He's getting up there.
He's 40 years old. There's been a structural break, right? Which is at 40, you're fighting all kinds of things. You're definitely not going to be winning 20 games. And you could do the soccer players. Lionel Messi, if you sign him on now as Barca, are you going to go back to the top of the league? I don't think so. There's been a structural break. Mean reversion works until it doesn't. So what's the question I'm asking about the US market? Is the US equity market going forward like the market of the last 100 years, or has there been a structural break? And I'll give you a clue. Until 2008, I used to give leeway to people using historical risk premiums in the US, looking backwards. You think what happened in 2008? Well, that's a question that shouldn't be asked because we know exactly what 2008 brought us. It brought us a reminder that we were in the 21st century. It took us 8 years into the century to say, hey, you're not in the 20th century anymore. That this was no longer an economy where the US was the global economy, that we were truly a global economy, everybody locked at the hip. And that the risk premiums for the last century are probably not the right risk premiums used for the future, even if they were right for the last century. And that's a statistical question Julian raises. How do I even know what the risk premium was over the last century? There's a statistical question we'll have to examine, but there's a structural question. And as I said, 95% evaluation, the assumption is we'll revert back to the past. So we're going to start with that process and ask some mechanical questions about that process. But let's say you decide to stay with the status quo, estimate a historical risk premium. Okay? To get that historical risk premium for the US, and I'm going to give you some choices about time periods. I want you to tell me what time period you're going to use to get a historical risk premium. You could use just the last year. In which case, what's your risk premium going to look like? What did stocks do last year, Jacob? 25%. You know what the T-bond rate was last year? The return on T-bonds was minus 1.6%. How did the return become negative last year? What happened last year to make the T-bond return negative? The coupon rates were positive, but the interest rates went up. The price of the bond decreased. So if I looked at last year, equity risk premium was about 26.6%. What's the problem with using that? Well, because last year was a really good year. We know, if you know any sense of common, that this is not going to be the case going forward. So 1 year, it's too short a period, right? How about 5 years or 10 years? What's a test of when a period is long enough that you can trust a number? What are we taught in statistics that allows us to gauge the trustworthiness of a number? You computed it, but cycles are tough to guess in the market, right? There's a standard error. What does it come from? How volatile stock returns over time. And if stock returns are volatile, that standard error is going to be large. And if the standard error is large, I can give you an estimate. But if I'm following the path of truth in advertising, I have to say this is the range on that estimate. So 1 year won't do, 5 years won't do, 10, 100 years even is not quite enough. You're going to see shockingly large standard errors with 100 years. So even if you believe that the future is going to look like the past, you're going to run into a second problem. I can give you a number, but then I'm going to give you a range on that number is so large that you say, what am I going to do with this number? I'm starting to dig a hole for historical risk premiums that I hope to bury them in. But the foundations are, first, you can't assume the future is going to look like the past. And the second is, it's noisy. Noisy in the sense of big standard errors. And there's a third problem with historical risk premiums. They push in the wrong direction. Let me explain what I mean by this. Let's say 2022, 2011 is too far in the past. 2022 was a terrible year for stocks. Stocks were down about 24%. Let's assume I'm computing a historical risk premium, right? I computed through 2021. Now I had a really bad year for stocks. I bring in 2022 into my calculation. When I bring in a really bad year of stock returns, what's going to happen to my risk premium? Is it going to go down or go up? It's good. You brought a really bad year, negative number, you bring in a negative number, your stock returns are actually going to get lower. So your risk premium actually will go down after a terrible year for stocks. Intuitively, think of what I'm asking you to say. You're in a crisis, stock prices drop 25% a year. I said, don't worry, things have become much safer. Use a lower risk premium. That's what I mean by pushing in the wrong direction, because if you think about risk is coming from your gut, my guess is after a really bad year for stocks, you're feeling more risk averse, not less risk averse. You should demand a higher premium, but historical premiums are going to push in the wrong direction. They're going to push up when you're in a bull market and everybody's optimistic. They're going to push down when you're in a crisis. And that's not the direction you want risk premiums to go. We've always known this about historical risk premiums. But you know what the argument that people use for using historical risk premiums is, right? What other choice do we have? How do we get a forward-looking premium? You can't go around asking people. People try with survey premiums. They're so unreliable. So 30 years ago, I decided that this wasn't working for me. I said, I want a forward-looking premium that's dynamic, that changes if I'm in the middle of a crisis. And I stole an idea from the bond market. Bond markets are not that creative, but this is an idea that I like. Let's see how much of your foundations class you remember. How do you compute the yield to maturity in a bond, Diksha? What's the process by which you compute the yield to maturity in a bond?
Look at the face value and what.
Well, first, before you, okay, price and face value, what else do you look at? And coupons during the period. So finish the process off. So I've got the price, I've got the coupons, I got the face value. What's yield to maturity? It's
You bring it back.
It's that discount rate that makes the present value of the cash flows. There you go. It's an internal rate of return for a bond, right? So I'm going to frame this, and I'm going to give you a very simple, intuitive way of thinking about equity risk premiums. So Bradley is going to be my guinea pig today, right? So I told you the rates right now, 4.5%. Let's round it up to 5%, right?
Okay.
Let's suppose I promised you $1 in cash flows every year forever in perpetuity. And let's assume that I have an entity that will keep paying it out. So even after I pass it. So if I offered you $1 every year in perpetuity guaranteed, how much would you pay for that cash flow stream?
It would be 1 divided by the discount rate.
1 divided by 0.05 would give you $20. Do you see why $20 would do it? Because if you took $20 and invested at 5%, what do you make every year? $1. So basically it works out. So if dollar with certainty every year in perpetuity would give me $20. Julian, I'm going to pick on you now. So now I'm going to give you the same cash flow stream, $1 every year. But rather than it being guaranteed, there's going to be risk in it. It's going to be risk associated with the typical equity investment. Would you pay less than 20 or more than 20 for that? Less than 20, right? Why? $20 for a guaranteed cash flow. This is now an uncertain cash flow. You're saying, I'm not paying 20. How much less? Give me a number. $5? So that's a good point, right? But the more risk, less you'll pay, right? So let's suppose this is the collective risk of all equities in the US, and it's a subjective number. So tell me, $12, $15, $10, what would you pay for it? $13, right? Once he tells me that, he's given me his equity risk premium. Do you see why? Because if you make $1 every year and you pay $13, 1 divided by 13, I wish you'd given me 10, it'd be a nice number to work with. But you pick what would be what, 7, so basically it's about 7%. 7% minus the 5% risk-free rate gives you an equity risk premium of 2%. If Margaret had told me $10, that's an expected return of 10%, the equity risk premium is 5%. You tell me what you pay for something, whether you like it or not, you've given away your equity risk premium, right? The less you pay, the higher the risk premium. Today, we're going to bring that, maybe today, now I don't know whether you'll get to it, we're going to use that same idea to get an equity risk premium for stocks. By doing what? Do we know what people pay for stocks? Every minute of every day, right? There's the index number right there. Do we know what expected cash flows are? Not as easily as the example that I gave you, but we can estimate them because we have history. These are 500, if it's an S&P 500, there if earnings and cash flows, you can project them out. And once I do that, I can do exactly what I did with a bond, compute an internal rate of return that makes the present value of the cash flows. It's messier than a bond, I agree. But it's a number that will be forward-looking because it's based on expected future cash flows. And will it be dynamic? Yeah, because every time the stock index changes, the risk premium is changing. Remember last Monday when we woke up to a tariff news and the index was down 3%? When the index drops, what's happening to the risk premium? They go up, just like bond prices and interest rates. That makes complete sense, right? You woke up to a crisis, your risk premium goes up. We're moving in the right direction. It's going to be forward-looking and dynamic. And it's a number that we can track over time. So we're jumping ahead to that. We'll get to that soon. But first, I want to wrap up our discussion of risk-free rates. Now, Julian, just before the class started, asked me to mention which packet. So let me be clear. The intro packet is done. Everything we're going to do, other than the start of the class test, is going to come from that packet 1. Remember last session, we were talking about estimating a risk-free rate in Brazilian reais. We have the government bond rate, right? You think, what if I have a currency with no government bonds? We'll talk about that. We have a government bond rate. But I said you can't use the government bond rate as your risk-free rate. Why not? What? Because governments have risk, right? They might not pay you back. So what do we have to do? We have to take out from the government bond rate what we think is due to that default risk. And I gave you 3 ways of doing it. One is, I said, if you can find a dollar or a euro bond issued by that government, you can take the difference between that rate and the T-bond rate. So for the Brazilian government, that works out to be 3.17%. Okay? You subtract the 3.17% from the government bond rate of 12.3%, you get a risk-free rate of 9.17%. That's approach 1. But the problem with that is government bonds don't often get traded. You might say, I don't trust the government bond rate. So let's try a second one. I talked about the sovereign CDS market. If you've never heard of it, you're not alone. Lots of people have it. It's a way you buy insurance against default risk. It's a market set number. That number was 2.82%. You subtract that from 12.3%, you get a risk-free rate in reais of 9.48%. Already you can say, which one should I use? Hang on, I'll give you a third one. I say, I don't trust the market, I don't trust the government bond, but I trust the ratings agency. A strange place to end up. But based on its rating, the default spread is 2.83%. You subtract that from the 12.3%. If you just had to pick the risk-free rate, which one's going to give you the highest value, the lowest risk-free rate or the highest one? That's like the lowest one, right? So this is great. I can pick whatever I want. I'm going to say something that's going to sound nonsensical, but I'll back it up. It doesn't matter which of the 3 numbers you pick if you stay consistent, because you're going to come back to this number again later in the calculation. I'm not going to be mysterious. What are the 3 numbers that go into my cost of equity? A risk-free rate, a beta, and an equity risk premium, right? You know what? This number is going to come back when I compute the risk premium for Brazil. So if you pick a big default spread here because it gives you a lower risk-free rate, that same bigger default spread is going to give you a bigger equity risk premium. So it's actually good news because it means don't pontificate about which number to pick. Pick one and move on, and just remember which one you pick. That's the only requirement. It'll even out. So it is true that those numbers could change, but you can estimate risk rate. In the case of Brazil, I had all three. In the case of India, I have 2 out of the 3. Which one is missing? I can find a sovereign CDS and I can find a rating, but India does not issue dollar-denominated bonds. But if I picked Gambia, there are no government bonds. You're essentially in no man's land, basically, because you might not even be able to get a default spread using any of the approaches. And maybe if you get a rating, that's all you can do. So beggars can't be choosers. The currency you pick, there might be only one way. Just take that and move on with it. But if you have inflation that's high, we talked about the possibility of doing everything in real terms. Let's be very clear on what that means. When you compute things in real terms, you're ignoring inflation. It's called constant dollars. You're acting like the only way you'll be able to grow your revenues is by selling more items. You can do your cash flows in real terms, and already you can see real cash flows will generally be lower than nominal cash flows. Why? Because inflation is not helping you. So by itself, you think this is bad, I'm getting lower cash flows. But to be consistent, then you have to use a real discount rate that has to come from a real risk-free rate. So how the heck am I going to get a real risk-free rate? For the last 20 plus years, and it's only in the last 20 plus years, in the US, I talked about the TIPS rate, an inflation-protected treasury rate. Staying with the assumption that treasury doesn't default, here's how the TIPS rate works. Right now, the TIPS rate, I think, is about 2.23%. You go buy a 10-year TIPS bond, the rate is 2.23%. Can somebody help me on what exactly I will make every year on this bond? How does this work? Go ahead.
It's the rate plus the inflation.
It'll be whatever the observed inflation rate. So let's say next year the inflation rate is 3%. I will get 2.323% plus 3%. What if it's 7%? I'll get 2.23 plus 7%. What if it's minus 1%? It'll be 2.23 minus 1%. You see what this does, right? It guarantees you a real rate of return, not a nominal return. So you could argue it is a real risk-free rate. But I've almost never seen a valuation in the US done in real terms. And there's a good reason for that. The world operates in nominal terms. In fact, this April 15, when you file your taxes, try this. Say, look, I took the income from last year, but I inflation adjusted the income. I really didn't make 150,000. In constant 2023 dollars, I made only 121,000. I'd like to pay less in taxes. The IRS is going to say, that's nice, but we tax nominal income. The world revolves around nominal numbers, so it does make sense to stay with nominal numbers. So why would you use real numbers? Because inflation gets so high and unstable in some countries, you finally give up and say, I'm going to do everything in real terms. Latin America used to be the epicenter for real analyses because inflation was such a bogeyman. And I need a real risk-free rate for those projects in Venezuela and Honduras and Brazil. And you say, can I take the TIPS rate, which is a real risk-free rate I get in the US Treasury market, and use it there? I'll give you the easy answer first, and then I'll give you the qualifiers. Yes. But only if you assume what? What keeps, in an econ textbook, real risk-free rates should actually be the same around the world. Because the real risk-free rate in Brazil is 4%, it's 2.2% in the US. What should happen in that? Capital should flow from, let's not even use the word arbitrage. Capital flow where the real returns are highest. So you should have capital flowing from the US to Brazil, which will push the real rate down in Brazil towards it. So in a world where there's no limits to capital flowing, and that's obviously a utopian world, the real risk-free rate is the real risk-free rate no matter where you are. I'm going to hold on to that word because the alternative to me is terrifying in terms of estimating a real. And if you ask me to do a real valuation of a Brazilian company, I will start with the 2.23% TIPS rate and hope and pray that capital flows enough for it not to be too different. Yeah? We'll come back and say maybe there's different ways of doing it. But this is the only observable updated real risk-free rate you're going to be able to use. And I'm going to take it and work with it in spite of its limitations. So let's say I do this, what I did with the Brazilian real for multiple currencies. I did the start of 2025. Here's what the world looked like to me in terms of risk-free rates. So you can see that risk-free rates, so the way to read this is the height of the column is the government bond rate. So let's take Turkey. The Turkish government bond rate is 27%. But there's default risk in Turkey. You subtract out the red part is the default risk. What you're left with is a risk-free rate in Turkish lira of about 22%. Let's pause and think about what that does, right? You start with a 22% base and you start adding stuff to it. What's your cost of equity and capital going to look like? Really high numbers. Yesterday, I valued this Turkish company called Enka in Turkish lira. So it's an exercise where you're saying, will this hold up? Because you're looking at 30% cost of capital. You think about discounting it. Trust me, it's going to be okay. You can still value companies with 22%, but you can see that risk-free rates vary across currencies. So I have a very simple question. I think we kind of answered in the last session. Let's kind of nail it down. Remind me again why risk-free rates vary across currencies, Ria? Why risk-free rates? Why is the risk-free rate high in lira? Then, but remember, I cleaned up for the risk, right? So if I showed you government bond rates, that would explain it. But if I've cleaned up for that risk, what's left? You want to pass it on to Urmila? What do you think? High inflation currencies have high risk-free rates. Low inflation currencies have low risk-free rates. And deflationary currencies could have what? Negative risk-free rates. We've cracked the code here. That's exactly why currency choice is not going to matter. Adil came to me at the start of the class and he said, I'm valuing a Swiss company in Swiss francs. Okay? When I did this, Swiss franc rate was mildly positive, but he said it's turned negative, right? Now, by itself, if you looked at a negative risk-free rate, you're going to end up with a really low cost of capital. But a negative risk-free rate goes with deflation and low growth. So when you do your cash flows, you have to stay with Swiss franc. And the way it'll play out is, you said their operations are in the US, right? So your cash flows are all going to be in US dollars, but to do your valuation in Swiss francs, what do you have to do? You have to convert dollar cash flows into Swiss franc cash flows. And what do you need for that? You need future exchange rates. And if your inflation rate is minus 0.2%, and the inflation rate in the US is 2.5%, in very general terms, what should happen to that exchange rate?
I think the Swiss franc
will appreciate, right? It's called purchasing power parity. It's one of the, in fact, the economists used to have this index called the Big Mac index, where they used to measure what a Big Mac cost in different parts of the world. It was actually a very good predictor of what exchange rates would do, right? So when you forecast the cash flows in Swiss francs, what will happen is whatever you gain by having a lower discount rate, you will lose when you do that conversion, because your 7% growth in US dollars will become a 5% growth in Swiss francs. Now, do you see why I was okay valuing Enka and Turkish lira? I did give them sky-high discount rates. But when I came to estimating growth, I gave them a 25% growth rate. You see, that's absurd for an infrastructure company. Their real growth is only about 3 or 4%, but if you think about the inflation that's embedded in a 22% risk-free rate, that inflation is going to make your growth rates also high. If you pick a high inflation currency, you will have a high discount rate. That's a given. But if you pick a high inflation currency, you also will have much higher growth rates. You can already see the pathway to ruin here is to mix and match. If you decide to value the company in US dollars and you leave the growth rate as a US dollar growth rate, and you discount it back at a Swiss franc discount rate, what are you going to end up finding? Very high value. You're going to find the company as a very high value for all the wrong reasons. Conversely, if I took a Turkish company, estimated the cash flows in dollars, and used a Turkish lira discount rate, I will devastate the company. Mistakes in valuation come from mixing and matching inflation rates, different inflation rates in your cash flows and discount rates, and that's what you're trying to avoid. So risk-free rates vary across currencies. Can they vary across time? Stupid question. Of course, they can vary across time, right? The 4.5% you're looking at the T-bond rate. Remember, your project is due May 5th. I will make a prediction that I'm willing to put $10,000 behind, that the T-bond rate on May 5th is not going to be 4.5%. Maybe I shouldn't put 10,000, it might end up there. But you see why, right? It could go up, it could go down. What causes interest rates to change over time?
On market.
But that's, kind of, you're very, because it demands, so what drives bond markets pushing up rates or pushing? And please don't say the Fed.
Not the Fed.
It's not.
Lots of things impact.
No, it's actually one thing, right? It's inflation and real growth. It's two things, right? Right. But basically, inflation and real growth drive it. Inflation goes up a lot. You should expect the T-bond rate to go up a lot. It goes down over the period. You're saying, what can cause inflation to collapse? There's the COVID collapse. Between February 14th and March 20th of 2020, Treasury rates in the US imploded. They went from 3% down to 1.5%. They kind of stayed down there for a while. But what is it about COVID that made Treasury rates drop so dramatically?
Real growth was.
Well, remember, COVID, basically, you had the economy, at least the fear was the economy would implode and people would stop buying stuff. Deflation, I mean, it turned out in hindsight, it was complete fantasy. But the market was basically building in those expectations. So rates will vary across currencies, they vary across time. Don't fight it. Fight it in the sense you want a discount rate, you want it to stay locked over the next 3 months. It's not going to happen. Your rates are going to be moving. Luckily for you, you can make your discounted cash. You can even put the T-bond rate as a direct input from Yahoo Finance, right? So you don't enter the number. Might not be a bad idea because you can create an Excel spreadsheet that's live then where your valuation gets updated every moment of every day. Hopefully not by too much because if a lot is happening, then you're having the equivalent of COVID and a lot of other things could change as well. But interest rates do vary across time. So if you have a currency where there is a government bond, we at least have a pathway to getting risk-free rates, right? Getting default spread. But there are about 120 currencies around the world where there is no government bond in that currency. Doesn't mean those governments don't borrow. Much of Africa, you will not find a 10-year government bond. Outside of Nigeria and South Africa, you're going to have a tough time finding a government bond. Do those governments borrow? Yes, they borrow from the World Bank. They borrow from commercial banks. They don't issue bonds. Saying, how do I get a risk-free rate in those currencies? I think we've created the pathway because if differences in risk-free rates come from difference in inflation, there's another way to get a risk-free rate that doesn't require a government bond. I'll give you an example. 2015, I was valuing an Egyptian bank. Why was I don't know. I was a moment of weakness. I wanted to value an Egyptian bank in Egyptian pounds. And I wanted to get a risk-free rate in Egyptian pounds. I went looking for a government bond rate in Egyptian pounds, none out there. So here's how I proceeded to get the risk-free rate in pounds. And tell me whether you go along with the logic. The T-bond rate then was about 2%. That's a US, you're saying, why are you going to a dollar risk-free rate? I'm going to start there. And then I estimated two numbers. The first was an expected inflation rate in the US, which at that time was 1.5%, and an expected inflation rate in Egyptian pounds, which is 15%. If I'm in a hurry, I'm done, right? Because basically to get a risk-free rate in Egyptian pounds, I'm going to take the US T-bond rate of 2% and add the differential inflation, which in this case would be 13.5%. 2% plus 13.5% is 15.5%. If I wanted to get fancy, maybe to show off, risk-free rates have this compounding effect. Inflation and real interest rates compound. What does that mean? To get the risk-free rate, I'm going to start with 1 plus the USD bond rate, and then take the inflation in the two countries and subtract out 1. All that gymnastics got me to 15.57%. Now you see why the approximation works pretty well. 15.5%, I could have got there a lot sooner, but it's differential inflation. In fact, when I showed you that picture with government bonds, there are some government bond rates there that I don't quite trust. Because in much of the world, government bonds are not like T-bonds, widely traded. They're issued by the government, and banks in the country are forced to buy the government bonds at whatever rate the government specifies. It's not a market set rate. You know how you can check to see whether you can trust the rate? Do the differential inflation. If the government bond rate is 11%, inflation is 30%. That government bond is not. So I actually do this when I get a government bond in a currency that I'm not familiar with, just to make sure that that number is even a good starting point. This will always work with any currency. All you need is the T-bond rate or a German euro bond as your starting point, and then a differential inflation between that currency and the US, if it's dollars, or that currency and the euro, if it's German euro bond rate, to get a risk-free rate in any currency. Any questions on this? Okay. I do need two numbers there, right? The expected inflation in dollars and the expected inflation in Egyptian pounds. The expected inflation in dollars is easy to get. How do I get it? Difference between the T-bond and the TIPS rate. I think we might have talked about this. So the T-bond rate at the start of the year was 4.58%. The TIPS rate was 2.23%. That's a 2.35% difference. I'm not going to do any dances. The market gives me that number. I'll trust it a lot more than any macroeconomist giving me a number, because there's real money behind this number. Hundreds of billions, trillions of dollars in T-bonds. So they expect inflation. Yeah.
Is it one expected and one observed in case views observed?
No, observed in what sense? These are both expectations, right? The TIPS rate, the 2.23% is an expected real interest rate over the next 10 years. The T-bond rate is an expected T-bond rate over the next 10 years. So what part of that is?
Observed inflation or expected?
It's always expected. You might use observed inflation as expected. Why? Because you get desperate. Right? That's what we often do. And if you ask me to get an expected inflation in Egypt, that was my first stop. I went and looked at the observed inflation rate in the most recent year. But if you do that, you got to be very clear on why you're doing it. I'm going to give you a suggestion on if you want to get an expected inflation in countries, we can do it easily and at no cost. That's a big criteria for me. If you visit the IMF's or the World Bank's website, they have some really good data. It's really difficult to kind of work with the data because being user-friendly is not top of the list of priorities. But they actually have expected inflation rates for every country for the next 5 years. Not quite 10, but this 15% came from the IMF's forecast of inflation in Egypt for the next 5 years. Am I happy with it? Not really, but it's the best I can do. But essentially, that's going to drive my risk-free rate. Start of 2022. And I walked into this class, the T-bond rate was 1.5%. And it's one of the lowest rates we'd observed in history. In fact, come off a decade where rates had been low. And it was driving people crazy to different extents, depending on how old they were. The first reaction was 1.5% is a really low rate. Can I replace it with something more normal? What is normal? You look at an average over the last 10 years, 20 years, 50 years. In fact, if you look at the last 30 years, the T-bond rate is about 5 to 6. The question is, can I just take the risk-free rate of 1.5% and replace it with a normalized risk-free rate? In fact, Duff and Phelps, which are kind of a lot of appraisers depended on, suggested this as a practice in the period of low rates, is to take the low rate and replace it with a more normal risk-free rate. Some of you young might be trying to think about doing the opposite now, 4.6%. That looks like a really high rate, at least relative to my frame of reference. Can I replace it with 3%? My advice is don't mess with it. And here's why. Let's suppose January 1st, 2022, it's 1.5% is the rate. You replace the 1.5% with a 5% normalized rate. You proceed to do your valuation with a 5% rate. Lead me through what's going to happen. First, your cost of equity and cost of capital are going to be higher, right? You discount the cash flows back, your odds are you're going to find the stock to be expensive. The value is too low relative price. You're not going to buy the stock. You know why we use the risk-free rate in this process? It's an opportunity cost. It's where you put your money if you don't want to buy a stock. So in your world, what are you going to do? You're not going to buy the stock, and you're going to go find that normalized T-bond that gives you a 5% rate. Good luck with that. You're living in a fantasy universe here, right? This isn't an abstraction. This is an actual opportunity cost. If the opportunity cost is 1.5%, don't go looking for trouble by putting in a 5% rate. And the opportunity, if the rate is actually 5%, don't replace with 3%. You make the opposite mistake. I'm actually making your life easier because I'm saying whatever the T-bond rate is at the time you do the valuation or whatever the risk-free rate is, just let it ride. It is an opportunity cost. Don't normalize things. Don't try to clean up things. Don't say, look, I'm going to make predictions on rates. People are, those predictions are not worth the paper they're written on when people do it. But more significantly, even if you can, you don't want to bring it into your valuation. Because if you're right about rates going down, there are far easier ways for you to make money, right? Go buy T-bond futures. This is not the place to bring in views about interest rates. So I've always pushed back against normalization, and many of you might go to work at places where people try to normalize rates. And I want you to remember the argument against normalization. It's not that you don't have a view on rates, but this is a valuation of a company, and the risk-free rate is an opportunity cost today. So let's take on this Fed did it challenge. I told you that coming into 2021 and into 2022, we'd come off a decade of historically low rates. That decade had the lowest T-bond rates in the last century. And of course, we asked people, why did that happen? And especially if they watch a lot of CNBC, the answer is the Fed did it, right? But the story, I'm sure you've read it, right? Quantitative easing, the Fed is. But let's see if in fact the Fed is what kept rates low. What I've done here, the black line is actually the T-bond rate. And then I constructed what I call an intrinsic T-bond rate. You say, what the heck is an intrinsic T-bond rate? What did I say the two numbers are that go into the interest rate? Inflation and a real interest rate. But in the long term, real interest rates and real growth are pretty much the same number. So every year I took the inflation rate that year and the real GDP growth that year. So if your inflation rate was 2% and real GDP growth is 3, 2 plus 3 is 5, I said the T-bond rate should be 5%. And I graphed it out. Do you think the two at least moved together? There's the 1970s. Why were rates high again? Well, it must have been the Fed must have been raising rates. No, it has nothing to do with the Fed. Inflation was high. Inflation is high rates. But take a look at the last decade. It's a decade with historically low inflation. It's the lowest inflation decade we've had in the last century. And in terms of real growth, it's a decade of anemic real growth. What's low plus low? Low. There's your answer. Why were rates low in the last decade? Because you had low inflation and low real growth. Could the Fed have an effect? Yes, at the margin. At the margin. Why did rates go up in 2022? Oh, the Fed must have raised rates. No, the Fed didn't raise rates. Inflation went up, rates went up. The Fed then chased the market, raising rates to try to catch up with the market. What will interest rates do in 2025? Frankly, I don't care what the Fed does. It's what inflation will do this year, and real growth will be that will determine. So if you have a scenario where you think that inflation is going to increase for whatever reason, some macro story, it's going to show up as higher interest rates, higher T-bond rate. It could also be a story of real growth increasing next year, because of tax cuts. That too will cause interest rates to go up. What drives rates is fundamentals. And for 15 years now, watch this discussion devolve into what will the Fed do next week? What will it do next month? And I think it's a very unhealthy discussion because it makes it sound like the Fed sets rates, that if they wanted to bring rates down to 2%, they could do it. And the danger of this is politicians are going to put pressure on central banks saying rates are too high. You got to lower rates. And you know what happens if the Fed lowers rates in a period of high inflation? You get Turkey. Because that's exactly what's happened in Turkey, is every time inflation goes up, and there is no semblance of independence of the Turkish central bank. There's the Fed at least has this history that from the top comes the command. Rates have gone up. You guys have to lower your rate. And the only rate the Fed has, the central bank that has to lower, is like the Fed funds rate. And they lower the rate. And when you lower the rate, what's the signal you're sending to market? We don't care about inflation. expected inflation goes up even more. This is like you're moving in the wrong direction because you've lost track of what it is that drives interest rates. Julian, your question?
You said if the Fed says that rates are going up, they're predicting what will happen, they're not actually.
No, the only rate the Fed actually changes the Fed funds rate, that interbank borrowing rate. So they can tell you they're going to raise it, lower it. But let's face it, that's a number that none of us ever faces. The rest of the rates are set by the market. The Fed's influence comes from the fact that they do have access to information about both inflation and real growth. There are 10 federal banks around the country, they collect data. It's an amazing amount of data. Not all of it is shared with the rest of the world. But when the Fed raises rates, here's the mind of the market. They must be seeing something on the ground that leads them to believe that inflation will go up. They're raising rates to try to bring inflation down. And that's almost entirely an earned respect. Now, that's why this is the legacy of Paul Volcker, 1979. He came in and he said the only focus of a central bank is to make sure inflation doesn't, everything else is secondary. And for 40 years in the US, people have believed that the Fed will put inflation front and center in terms of deciding what to do. That's why I said the power of the Fed comes from the perception that it has power, that it is credible. You take those two away, the Fed stops mattering. Japanese central banks, nobody cares what they do, right? And a lot of the world, central banks have zero power over markets because nobody has any faith in them collecting information, and they have no credibility. So if nothing else you get out of this class, hopefully the next time you see on CNBC there are people who are Fed watchers. Their entire life is watching the Fed, predicting. I can't think of a more empty life to live than watching something that doesn't matter and forecast what it will do. But this has become almost an entire exercise in itself, right? Yes, Ravi.
So outside of sending that signal from all the data that is seeing, what is the real impact of changing the repo rate on
There's it used to be stronger 40 years ago. It used to be that the Fed funds rate was connected to other rates that were pegged to the prime. At one point in time, there was this rate called the prime rate in the US. The prime rate, and I remember the 80s, people would talk about the prime rate. The prime rate was a rate that banks set that drove a lot of the other rates that you and I faced on our credit cards and stuff. So in those days, when the Fed actually raised rates, it affected the prime rate, and through the prime rate, it affected the rate. Those days are done. I mean, you ask people what you could ask a banker what's the prime rate, and they'll say, I have no idea. We've stopped tracking it because more of our rates are tied to market interest rates. Your mortgage rate, nothing to do with the prime rate, nothing to do with the Fed funds rate. It's driven almost entirely by what happens to the T-bond rate. You look at a graph of mortgage rates versus T-bond rates, they kind of move together. That's why last September, when the Fed cut the Fed funds rate, in the 3 months following, mortgage rates didn't go down. They went up because the T-bond rate went up. So the actual rates that are tied to the Fed funds rate are very few and limited. There are some business loans that might be tied to the Fed funds rate, but it's probably 10% of the overall loan market, and it's getting smaller. So the actual control the Fed has over the rates that you and I see, and you and I includes businesses, is very limited. That's why it's almost entirely a signaling exercise. Somebody back here had a question? Yes, go ahead, Jessica.
Long-term bond rates are kind of tied to like Fed short-term interest rates, because I feel like every time the Fed makes an announcement, there is like a large movement where like long-term.
I think you might see this is, I think, we have our priors because we watch data, but we watch data selectively, right? We watch the data. I think it's, one reason I pull back data going back to 1954, which you can from the Fed. Look at the Fed funds rate and the T-bill rate and the T-bond rate, is to see if my priors are right. And it turns out that the Fed effect is primarily at the short end of the spectrum because Fed funds is a short-term rate, so if there's any effect. The T-bond rate is a life of its own. It basically does whatever, inflation and real growth are driving it to do. That's why yield curves can get downward sloping. Is the Fed funds rate might affect the short-term rate, but the long-term rate does whatever long-term rates do. So the connection between the three is very loose. The correlation is like 0.03, 0.04. It's very, very limited. Much of what happens seems to be driven by macro factors that the Fed doesn't control. You know what, why we look to the Fed as a set of rates makes us feel comfortable, right? We think that, Jerome Powell can make our life easier, right? If all he has to do is lower the rates, the economy is going to, it makes us feel more comfortable and more in control of what's going to happen in the future. The truth is, the Fed doesn't control the future. That's why we charge an equity risk premium. So interest rates are interest rates. They're going to be driven by demand and supply and inflation ultimately. And of course, we talked about negative interest rates. You kind of answered the question. Ashima? Let's stop there. What exactly was quantitative easing? Because it must have been more, because Fed has always controlled Fed funds rate. What did they do in addition to that in 2000, after 2008, that went into this quantitative easing?
It was just like an influx of.
They bought T-bonds. That's all they did. They went in and bought T-bonds. It's a demand supply, right? And you're saying if they buy T-bonds, couldn't they lower the rate? And that's always been the other pathway. Say if they buy enough bonds, couldn't they lower the rate? You know how big the T-bond market is? It's like $8 trillion. Fed can buy 100 billion, people won't even notice. So the quantitative easing at the margin, again, by buying bonds, they might have lowered the rate from 4.57% to 4.54%. That's why I said at the margin, all of this dancing around can lower the rate. But if inflation goes to 7%, you can try to buy as many bonds as you want, but T-bond rates are climbing towards 7% plus. And the reason is simple. If I buy a bond, I want to make sure inflation is covered. Otherwise, I'm put at a deficit even before I start. So all of the quantitative easing, you look through the processes, we're tweaking the rate, not changing it fundamentally. So with negative interest rates, the one question though is, this is something we hadn't seen until the last decade. And it freaks people out. It creates some really strange implications. There was, I think 5 years ago, Danish homeowners were borrowing money to buy their houses, just like, you and I might. But the bank was mailing them. Usually when you borrow money, you pay the bank every month. The bank was paying them. So how can that be if you have negative mortgage rates? The bank will send you a check every month. You think, this is amazing. I want to live in this world. It's kind of a freakish world. Negative interest rates are never good news because it comes with deflation and negative real growth. You might be getting a check from the bank, but you're probably going to lose your job and your income is going to shrink over time. You got to play this process through. But there's the other thing about negative interest rates that troubles people. You're putting your money in the bank. So let's say you have $100,000. You put your money in the bank. What does the bank do? It takes away $1,000. You're saying, why would I do that? Why don't I just keep the money at home? That's always been the pushback against negative interest rates is, since you don't have to put your money in the bank and earn a negative rate, why don't you just hold on to cash? What's the answer to that? Let me ask you, how many of you have cash in your pockets right now? Relatively few, right? Maybe you have what, $5 just in case you see a homeless person, you want to give them the cash. No, we don't use cash. Sometimes we don't even take our wallets with us because we've got our phones with us. One of the consequences of being in a cashless society is we don't even know what to do with cash. Second, let's suppose that Witt has $10 million in cash, and he decides not to put it in the bank because they charge a minus 1% interest rate. So Witt is going to keep $10 million of cash in his apartment. Where do you live, Witt? I want to pass the message on because the next thing you'll have to do is hire security guards to protect you. There's a consequence here of having a lot of cash. So what I'm trying to say is interest rates can get negative and you won't hold on to cash because it's messy, it's painful, it's dangerous. But if they become minus 3%, you'd probably think more seriously about holding on to cash and hiring a security guard. So Interest rates can turn negative, but there's kind of a floor at which people will say, I'm not taking this anymore. I'm just going to keep my cash as cash. So negative interest rates can happen. The way I think I titled this blog was uncommon but not unnatural, because people said negative interest rates can't happen. They can. It's just unusual when it happens. You got to think about what drives it. So now let's talk about equity risk premium. So I laid the foundation, right? It's what you charge over and above. What affects it? Everything that happens around. It's the receptacle for all of your hopes and fears as an investor. So right now, you're looking at the hope now is that you look at economic growth and what you think it'll deliver, and the uncertainty in economic growth, inflation goes in there. You're worried about a crisis, it's in there. I wouldn't even list them out, but if you look at it, everything affects it. Government policy affects it. You're saying, so what? This number is going to be an unstable number. It's going to change over time. So any measure of an equity risk premium you come up with better be dynamic, because to say that your equity risk premium hasn't changed over the last 20 years is it's a denial. You're in denial. How can it not change? So everything affects equity risk premiums. Yeah.
But continuous risk, right? So
It is continuous risk, but that means you got to estimate it, input it, but you got to do the work, right? And if you're using a historical risk premium, it's not going to move. So let's set up the process with historical risk premiums. This was the exercise we started with. So I'm going to look backwards and I'm going to hit a historical risk premium. So at the start of every year, I compute a historical risk premium on my webpage. Why? Because I refuse to pay somebody for a risk premium. The data is already out there. I never use these historical premiums, but in case you're inclined to go with the past, I have the numbers for you. The historical equity risk premiums for the US, keyword is premiums, not premium, is somewhere between 5 and 14%. You think, how can you have multiple equity risk premiums for the same market? It depends on the slice of history you look at. I've looked at 3 possible slices. 1928 is my starting year, and you have 50 years and 10 years. I've also looked at the equity risk premium over T-bills as opposed to T-bonds. T-bills are short-term treasuries, 3 months, 6, and these are 3-month T-bills. T-bonds are 10-year T-bonds. The premiums are different. It even depends on how I compute my average returns. See, what does that even mean? If I give you 100 years of stock returns, the easy way to compute an average is add the 100 numbers up, divide by 100, right? Simple average. But the problem with doing that is returns are compounding. I'll give you a very simple example to see how the compounding plays out. Let's say you have stocks double in year 1. What was the return that year if they doubled? Plus 100%, and then they halve the year after. Minus 50%, right? So how much money do you make over the 2 years? Nothing. But if through the magic of arithmetic averaging, you made a 25% return, you just don't know it. 100 minus 50 is 50 divided by 2. Arithmetic averages miss the compounding effect. So what can you do? You can do what's called a compounded average, a geometric average. We look at your starting number, your ending number, and you look at what you make. So if you started at 100, you ended at 100, I'm not going to try to fool you by saying you made any money. You did not. So you got, how far back do you go? T-bills or T-bonds, arithmetic or geometric averages. Already you can see the danger of historical risk premiums. Remember we talked about bias? Ashima, let's say you are an appraiser for a private business that's up for splitting in half because it's in the middle of a divorce. You want a low number, right, for your client? So which of these numbers are you going to latch on to? Highest number or lowest equity risk premium? Highest, because you want the discount rate to be high. So you're going to pick 13, 14%. I ask you why. It came out of Demodrin's historical risk premium. Put that in because you can blame me there, right? Conversely, if you want a really high number for your value, you're an equity research analyst, you want to convince me NVIDIA is cheap, you could latch on to maybe the lowest number, 5.44%. If I let you pick and choose, you're going to pick whatever number justifies, and you'd be amazed at how much bias plays out in this process. So if you're going to use historical risk premiums, I'm going to put some guardrails on what to do. First, you have to go back as far in time as you can. It's a purely statistical reason. Remember I said every estimate of an average comes with a standard error? I've actually estimated the standard error with each of these numbers. And notice as I go from 100, close to 100 years to 50 to 10, the standard error is getting larger. It's pure. So if you want at least a reasonable chance of getting the risk premium right, you better not use a 10-year premium. The noise in that is going to be so large that the range you get will be useless. But even with 100 years of data, I'm ending up with the risk standard error of 2.2, roughly 2%. Hold on to that thought, because I'm going to complete the other two things I want you to do. Second, this is an equity risk premium you're going to use in your calculations, right? And remember when we talked about valuation, we talked about what the right risk-free rate to use was. Did we pick T-bills or T-bonds? And the reason is valuation is long-term. So I'm going to take the T-bills out of the picture. This is good. I'm getting rid of the numbers I can't use. So I want to go back as far as I can, and I want to use T-bonds. Final question. This number is going to go into a discount rate. And what happens to that discount rate? I use a discount year 1, then year 2. It's going to compound over time. I think logic alone drives you towards a geometric average. So T-bonds, longest time period, geometric average, 5.44%. We talk about false precision in valuation, 0.44%. I'm getting a little carried away with the precision here. You know why this is false precision? That's my estimate of the equity risk premium going back close to 100 years, geometric average, stocks versus T-bonds. But here's a dirty little secret I'm not letting you in on. The standard error is roughly 2.1%. So if I tell you the equity risk premium is 5.4%, and then I say, oh, by the way, I forgot to tell you that the standard error is 2.1%. Do you want to quantify what that means to me if I have a 2.1% standard error? Statistics, what do we do to get an estimate of the range?
Would translate to, I think, like about 4 point.
No, let's not go that far. 2 standard errors will get me to 95% confidence, which means my equity risk premium for the US with 100 years of history, even if I assume mean reversion works, is somewhere between 1 and 10%, right? Fat lot of good that does you in evaluation. Your equity is something, you'd fire me on the spot if I were an estimator saying, what good is that to me? But that's what you're doing. Every time you use a historical risk premium, because nobody's talking about the standard error. So as I told you at the start of this class, I'm going to dig a hole for historical risk premiums and I'm going to bury them. The first problem is this standard error, noisy estimates. And if you have trouble in the US, think of how much more troublesome this is going to be if I ask you what the equity risk premium is for Vietnam. Or even much of Europe, because you had that break between 1940 and 45. Many European markets shut down. It's not even a choice. You can't even go back there. And second, by using the US market, I've opened myself to what's called survivorship bias. What is the most successful equity market of the 20th century? It was the US equity market. I picked the equity risk premium for the most successful market of the 20th century. What am I going to do? In 2024, I'm going to use it for the next century. But if you went back to 1901 and you had money to invest, you could have chosen to invest in the US market, but the US market wasn't the biggest market in the world then. It might have been the UK market or the Austrian market. You had no way of knowing what the best market of the century would be. You know what that implies, right? If you take an equity risk premium for the most successful market in the world, are you going to overstate the premium or understate it? You're going to overstate it. Why? Because you've taken the most successful market. You have no idea what the most successful market will be the next century. That's a survivorship bias. And if this problem is bad with the US, we have all this historical data, think of how much worse it gets if I ask you to estimate an equity risk premium for a market without much history. So at least I want to lay the foundations for, if I want an equity risk premium for Brazil or Vietnam or India or Indonesia or Poland, given that this historical data is not even a start here. You think, but India has historical data going back. You take a look at the Indian equity market in 1968 and come back and tell me you got historical data. It was a market of maybe 20 companies with very little liquidity. You don't have much historical data. So you have two choices. If I am a Brazilian company and I ask you to come and value me, first is you can ask me to come back in 100 years. So by then I'll have enough historical data for your market. Or you can try to do something today. I think the latter is a better strategy to adopt. So I'm going to give you three ways in which I'm going to try to estimate equity risk premiums for markets outside the US. In the first, I start with the US equity risk with all my qualms about what it is. Let's suppose I feel reasonably okay with this number. So let's work this out intuitively. If my equity risk premium for the US is 5.44% today, that's a historical premium. And I say, would you, and you're investing in Brazil, would you require a larger premium or a smaller premium? Everybody agree larger? Why? Because remember all those things I talked about that drive equity risk? Those are all much greater in Brazil than in the US, so larger. That was the easy part. Now the question is how much larger? Here's the first and the easiest answer. It comes with limitations. It's a number we've already used. When we computed risk-free rates for Brazil, what do? We started with the government bond rate and we subtracted out the default spread. It's a number like Waldo. It's going to come back again. And basically, if you take that number and add it to the US equity risk premium, you have an equity risk premium for Brazil. So if you remember, the number I got was 2.83% with the third approach. Let's suppose that's the approach I used on the risk-free rate. And that's where consistency is going to kick in. If you used a different number in the risk-free rate, stay with that number. If that was the number I used to clean up the government bond rate, I'm going to take that number and add it on to the US premium. You see, where did the 4.33% come from? I'll talk about that, but it's a number that I think I feel more comfortable with as my equity risk premium for the US. I add the 2.83% to it, and I get an equity risk premium for Brazil of 7.16%. This is the state of the art, if you can call it that, in how appraisers, analysts, and bankers estimate equity risk premiums for other countries. They take a US premium, God only knows where that comes from, or how unstable it is, and they add a default spread, either using the sovereign CDS spread or the ratings-based approach or a government bond spread. Go ahead and say, I'm done. Clearly it's a simple approach. The numbers are easy to get. What are the problems with this approach? Fundamentally or intuitively, what do you think the problem with this approach is? Yes, sir.
It's based on the government bond.
Basically, the 2.83% is what I would charge for buying a Brazilian government bond, right? The extra amount, because it's risky. But I'm not buying a bond, I'm buying Brazilian equities. So Diksha, help me out. If 2.83% is what I'm charging for buying a government bond, and I'm thinking about Brazilian equities. Are equities riskier than bonds generally or safer? They probably should be risky, so I would expect the risk premium to be larger because I'm talking about equities. So that was the first thing that bothered me when I saw this approach, because it was the default approach. I saw it used everywhere. So I'll give you the pathway I took. But Goldman Sachs about 30 plus years ago said, why even look at the government bond? There's a different way in which I can get an equity risk premium for Brazil. And here's what they did. They came up with the historical standard, backward looking, but historical standard deviations in the US equity index, the S&P 500 and the Bovespa. So let's assume the standard deviation of Bovespa is 30%, and the standard deviation in the S&P 500 is 18%. Let's do an algebra problem. If you're buying the 18% market, which is the US market, you're charging a 4.33% premium, right? But if instead you want to buy the Brazilian market, which is roughly 1.67 times more volatile, 30 over 18, 1.67 times 4.33% gives me an equity risk premium for Brazil of 7.22%. When this came out, people said, this is great. We're not looking at the bond market. We're staying with an equity. But this approach has a fatal problem. Do you know what it is? Anybody want to guess what the problem is? What is it based on? Standard deviation of the S&P 500, standard deviation of the local equity index, right? Think about what goes into the standard deviation of the local equity index. Obviously, it's all the risk in the country. But for prices to move, something has to happen, which is people have to trade. In a market where there's zero trading, the standard deviation will converge on zero. I computed this number. for the Bangladeshi equity market last year. And it's about 5% standard deviation. If I stayed with this approach, I'm going to be giving the equity risk premium for Bangladesh to be 1/3 of the equity risk premium that I'm charging for the US, which is absurd. Because you're comparing markets with very different liquidity. Every year I take this approach, I compute the equity risk premiums for every market, about 1/3 of the market. Look, I said, no way am I investing in those markets, because what I'm getting is a reflection of the liquidity of the market, not the risk of the market. So I'm going to give you my third approach. This is my default approach. I won't claim that it's the best approach, but it's an approach where I've tried to negotiate what I can in terms of compromises. I start with the 4.33%, just like I did in the first approach. But instead of adding the 2.83% to it, I scale up the 2.83% for how much riskier stocks are relative to bonds within the Brazilian market. You say, how do you deal with the liquidity issue? If there's light liquidity in one market, there's probably light liquidity in the other market. The Bangladeshi equity market has very little liquidity, but so is the Bangladeshi government bond. At least I'm comparing apples to apples. That ratio for Brazil was about 1.5. The Brazilian equity index was 1.5 times more volatile than the Brazilian government bond.
Simple. So for the standard deviation, how far are you going back?
Doesn't matter. Use the same for both, right? It's a ratio that matters, right? So unless you believe the ratio is going to be off, if you use 6 months, use 2 years, then it's basically a sense of how much riskier are equities and bonds within this market. That number gives me 8.58%. Very different numbers. That's a number you'd see in my valuation. And if you use one of the other two approaches, I'm not going to say you're wrong. It's just a different, it's not going to make or break your valuation. But I think you need to pick an approach that works across all countries, not one that just works on this country, because you might have to do this on 7 different countries for your company. Okay? And you got to make sure it's. So this is an exercise at the start of every year that I go through. Go ahead, Margaret. Yeah.
Does this require basically like going back to the country have to issue a US based?
It doesn't have to be. It can be a local bond. It has to be traded. There has to be government bonds traded. And therein lies a problem. That's available for only about, 37 countries that you saw. You see, what do you do with the rest? I'll talk about what I end up doing in practice, because it's very messy staying with local government bonds, trying to get this for every country. So start at 2025, like I think it started this for the first time in 1992. So it's kind of a 33-year-old database, the most downloaded data set on my website. I want to compute equity risk premiums by country. I start with the US premium. And as I said, I'll come back into the 4.33%. That's my starting point. Then I look up the sovereign local currency rating. Remember I said there are 2 ratings for every country, local currency and foreign currency. I look up the local currency rating for your country. If you're AAA rated, I classify you as a mature market, and I give you exactly the same equity risk premium as the US. Why? Because if you have 10 mature markets with different equity risk premiums, money is going to flow across them and even out the premiums. So every AAA rated country is going to get the same risk premium as the US. So let's name some AAA rated countries. Let's see how many you can come up with. Let's start with Europe. There are quite a few. You can go, so don't even look to the south. There's nothing there, right? So start Germany, work upwards. So you got Germany, Netherlands, Switzerland, Sweden. Okay? They all get 4.33% premiums. Let's move over to Asia. There's only one country in Asia with a AAA rating, which is Singapore. Okay? Go to Australia, New Zealand, both AAA rated. Come to North America, you got Canada, you got the US, both AAA rated. US less AAA rated than Canada because you got 3 different ratings agencies, and only Moody's still gives a AAA rating. But I'll hold on to that for the moment. And then you go to Latin America, don't even look for ratings with an A in it. Right? It's going to be B something, basically. I think Chile might be the only one that's tipped over into the A scale, but no AAA rated countries. For those countries which don't have AAA ratings, here's what I do. I take the rating and I come up with a default spread. If that sounds familiar, that's how I got the 2.83% for Brazil, right? That lookup table. I look at the default spread. When I first started doing this, I then would go looking for a government bond and equity index in each country. And as Margaret pointed out, 2 problems. One is a lot of countries don't have government bonds. And in the countries that do have government bonds, many are not traded. So I started cheating about 20 years ago and I haven't stopped. Instead of looking up each country, I look up two indices. One is an S&P index of emerging market equities. It's actually a widely invested in index. You can get the price every day. So you go to the S&P website, you can download the data for the last 5 years. I actually downloaded for the last 2 years. And then I found, and this was pure luck, I found an ETF that invests only in emerging market government bonds, which is traded, so I can get the price. And I looked up the standard deviation of the ETF. And you can see where I went next. I took the emerging market equity index divided by the emerging market bond index, and I came up with 1.35. What does that tell me? Based on those numbers, I'm going to take the default spread you have as a company. Let's say it's 2%, multiply by 1.35. It makes me 2.7%. Added on to the 4.33%. I've got an equity risk premium for your country. Question?
But isn't it a stretch problem? You're assuming.
There are lots of stretches here, right? But what is the part that you would unstretch?
Because you're assuming.
No, tell me, so what's the part that's a stretch? The 1.35?
Yeah, I think
So-
assuming all
yeah.
the emerging markets would be same.
So what's your alternative to that? Okay, so I think that when you make stretches, it's because there's no easy answer, right? Of course I agree, right? But if you decide, and there are people who say, well, I'm not going to use the 1.35 at all because it's too much of a stretch. And you know what they end up doing? Using just the default spread. Is one any better than 1.35? Isn't that a stretch? Sometimes people think if you don't make an assumption, you say, but you always have to make an assumption that when you use one as your ratio, you are making an assumption. I think I'm on safer ground assuming equity is riskier than government bonds. So this is the number I wrestle with every single year. I've changed the way I do this because the data has improved, but it's a work in progress. So here's what the world looked like to me at the start of 2025. Pick your favorite part of the world or your least favorite part, and let's go on a trip. I'm sorry, you don't have your nameplate. What's your name again? You're always Brazilian, right? So let's go through Latin America. Exciting place. This is like a jungle ride on Disney. There's what Latin America looks like. There isn't a AAA rated country in the bottom. Safest market. So basically the way to read it, there's the rating, which gives me the country risk premium. So the country risk premium is the default spread times 1.35, and added to the 4.33% gives me the equity risk premium. Safest market, if you include this, is Chile, right? Historically, that's been true. And why is the equity risk premium so low? Because the rating is high. There's no intellectual firepower here, right? Basically, it's driven by the rating. The riskiest market, probably no surprises. You got a tie between Venezuela is probably at the very peak, 28. That's your risk premium. Think of what happens to your discount rates, even if you do things in dollar terms, 27.6%. And you got Argentina, Javier has a lot of work to do. And basically, you can see the variations across Latin America. And you say, what is this number for all of Latin America? It's a weighted average. Weighted by what? By the GDPs of the countries. Brazil and Argentina obviously count, or Brazil at least counts for a lot more than everybody else because it's a larger. And I do this for every part of the world. But let me complete the process. You're saying, what is that black box at the top? Take a look at the countries, and you're very quickly going to see what they have in common. Guinea-Bissau, Guyana, Haiti, Iran, North Korea. Liberia, Libya, Madagascar, Malawi, Myanmar, Russia, Sierra Leone. These are called frontier markets. What do they share in common? They don't have a rating. Why do they not have a rating? Let's play it out. Let's suppose you take a job at Moody's. The first day at work, your boss calls you and says, I'm going to give you a country to rate. You're excited. First day you go, so where am I going? You're hoping for Switzerland. And they say you're going to North Korea. You probably will quit on the spot, right? There's a reason they don't have a rating. The rating agencies throw up their hands. Russia used to be in the rated column. It's gone because starting in 2022, the ratings agencies have just thrown up their hands. And for the longest time, I did not compute risk premiums for those countries. And my defense was there's no rating. But starting about 10 years ago, I said, that's not fair. You might have business in Syria or in North Korea. I don't know what kind of business it is, but some business. And you need an equity risk premium. So here's the process by which I estimate equity risk premiums for those countries. There are these services that measure country risk scores. The Economist does it. I use a service called Political Risk Services, not because it's better or worse, but because I've used it for a long time. I'm comfortable with how they do the numbers. Their scores go from low to high, low being the riskiest countries, high being safe. Last year, for instance, the highest score country, the safest country was Switzerland. The riskiest was a tie between Sudan and South Sudan and somewhere over there. I found, and they have political risk scores for North Korea and Syria and countries which don't have a rating. So I look up their country risk score. And they talked about stretches. I'm going to do a real stretch. Say, okay, I know the country risk score for Libya. Let's not take a different one. Sierra Leone is 59.5. I go looking for countries with scores between 55 and 60. I found 5. 3 of those countries had ratings and had estimated an equity risk premium for them. So complete the process. What do you think I did? I took the average across the 3. I attached Libya and Sierra Leone and said, thank you, I'm done. Is it a stretch? Absolutely. But if you can find a better way of estimating equity risk premiums in North Korea, I'd love to hear ideas here. But I have a number, no matter where you operate in the world, I can say this is what the equity risk premium looks like. I told you, it's the most widely downloaded data set on my, it gets used in the strangest places. Sometimes I can track where people are coming onto my, 1 month, Lithuania. Usually the top is, nice thing about having people in India follow you is that already pushes the numbers up. India's at the top, but then you have the English speaking, US, UK, Australia. But Lithuania was on top of the list. I said, what the hell is happening in Lithuania? Why are they looking up my risk premiums? And it turned out that for a period, privatizations in Lithuania, you were required to use my equity. I have no control over this process. So this gets used in strange places, in bad ways. I claim no responsibility for it. But at least now, if you run into an equity risk premium claiming to come from my webpage, people have visions of me doing country risk analysis all year. I have zero interest in doing country risk analysis. I have zero skills in that. You know why? And sometimes people really get pissed off at me because I gave their country a really high equity risk premium. People argue with me, we're safer than this neighboring country. How come my risk? I am not the one who's doing this. Moody's is doing this to you because I'm starting with your rating. So if you're from Turkey and you don't like the fact that your equity risk premium is higher than Greece, I'm not the one who assigned it. It's basically a function of ratings. And Greece used to be a lot worse than you are right now 10 years ago, and they've moved in the right direction because their ratings have improved. So if you get a chance, take a look at the Excel spreadsheet that contains this data because it contains all of the raw pieces that go in, and it gives you options. You don't like ratings, I give you sovereign CDS spreads as an alternative. But next session, we're going to talk about what to do with these equity risk premiums when you value individual companies.
I guess we